Henderson High Income Investment Trust had a very good start to the year. The NAV was up 11.9%, and that was good outperformance relative to the benchmark return of 8% there. In terms of income, so we declared dividends in total of 5.35p in the period, and that is again a continued growth from the previous half last year. In terms of the drivers of the outperformance in terms of the equity portfolio, so very much holdings within our financials. So insurers, Phoenix, M&G, Aviva, all had very strong periods in terms of share price performance, and that really benefited the trust in terms of delivering that outperformance. Also, some of our overseas holdings did well, so the likes of Tele2, the Swedish telecoms company, and Engie, the French utilities company, both beat profit expectations for the year, which again drove their share price performance over the period. In terms of dividends through the year, in terms of the trends we saw, bit of mix there, so continued good dividend growth from the banking sector, so really benefiting over the last couple of years through higher interest rates, but that tempered a little bit by some of the headwinds in the mining sector we saw, so those dividends are very much linked to their profit outlook, and given lower commodity prices, we saw dividend payments from that sector a lot lower in the period. In terms of a bit of activity, what we've done in the portfolio over the period, a few more holdings in internationals, so where we can go 30% overseas within the trust. We bought a couple of new overseas holdings. So first one was BNP, the French bank, well capitalised bank, well diversified, should see good benefit from European banking deregulation and also capital markets reform. And likewise, AXA, French insurance company, again, well diversified, good global exposure there, benefiting from what is a good solid solvency capital base of it, and pays quite an attractive dividend yield as well. In terms of some of the key sales we saw over the period, so firstly was SSE, the UK utilities company. They have got a very big capital investment plan over the next couple of years in terms of renewable energy, so building out wind farms, both offshore and onshore. And we're just slightly concerned about the returns they may make in that investment, given the build cost inflation we've seen over the last couple of years. Elsewhere, we also sold our holding in Sabre Insurance, the car insurance company. Had recovered its profits quite nicely over the last 12 months from a cyclical low. And we think from here, profit growth going forward will be slightly more difficult, given competition in the market, given rates are starting to come down, will become tougher going forward. So we use that kind of recovery in the share price to move on from the position. I think we've got to be mindful of some of the economic uncertainties out there. If you think about global market, the global economic outlook, very much one of slowing GDP growth because of the tariff impact. We want to see how that develops over the next 6 to 12 months. And then close to home, I think we've got to be mindful of the UK fiscal position. So, we've got a budget coming up. The UK government may look to increase taxes again, which probably flows through into consumer confidence, certainly over the next 6 months or so. So we're mindful of those. However, you've got to look at the positives as well. So, balance sheets for UK corporates and consumers are in relatively good health at the moment. And also valuations in the UK market are still very attractive, despite the strong performance we've had so far this year. So the portfolio very much continues to be balanced. So we own, good quality defensive businesses, resilient businesses, but also some of those cyclical names we think are particularly undervalued here going forward.